Be Wealthy and Smart, episode 712.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about individual stocks and specifically the FANG stocks and how they've gotten really overvalued. You know, it's really interesting, these stocks, this handful of stocks known as the FANG stocks, but now it's really expanded. So it's more than just Facebook, Apple, Amazon, Netflix, and Google. They also have Microsoft in there. And they've been kind of the place where individual stock pickers have been hanging out. So portfolio managers, hedge fund managers, people who buy individual stocks, they've sort of congregated to the FANGs because the FANGs, some of them have had very good earnings. Of course, we know Amazon has continued to sell a lot during this slowdown. We know that Netflix is where a lot of people are cooped up at home and watching movies. But yet we also know that advertising is down at Facebook and Google, or its parent company Alphabet as it's known. So not everything is all perfect. But what happens when you see a lot of money moving toward a handful of stocks is it can often be an indication that a topping process is in place. Because here's what happens. It's called window dressing, and that is the portfolio managers all want to have these stocks in their portfolio because in hindsight, looking backward, they've been where the performance has been. And the portfolio managers know that the public is going to get a snapshot of their portfolio. So they window dress, meaning they buy the stocks that have been the best performers in the recent past so that it looks like they've been smart and been in the right stocks all along, which may not be the case, but the window dressing makes it look like it's the case. Just like when you're watching CNBC and they put up on the screen what stocks those people own, you'll notice they always have the FANG stocks in there because if that's where the good performance is going to be, well, they want to have it on television that they've been owning those companies. So this is something that we don't know how long they've been owning those companies. We only know at a particular snapshot point in time that those portfolio managers own those companies on that particular day. But here's the thing. When you get a handful of companies where most of the money is moving, that is usually a topping process. And it looks like we have hit the moving averages and maybe we're bouncing off those moving averages. Maybe we're making a turn to go back lower in the S&P 500 and test those lows. That remains to be seen, but it wouldn't surprise me one bit. But here's how concentrated Microsoft, Apple, Amazon, Alphabet, and Facebook have become. The S&P 500 is now more concentrated in those 5 stocks than it's ever been, and they make up 22% of the S&P 500's market capitalization. That means the value of these companies, these 5, is 22% or 1/5 of the total capitalization of the top 500 largest companies in the U.S. This is even more than what we saw at the peak of the market in 2000, which was a tremendous bubble. And I'm not saying this is a bubble, but what I'm saying is that in 2000, at the peak of the bubble at that time, we had Microsoft, General Electric, Cisco, that is the technology Cisco, not the food Cisco, CSCO, Intel, and Walmart at that time made up 18% of the market cap of the S&P 500. And now we are at 22% years later. Here we are 20 years later, where 22% of the S&P 500 is made up of just 5 companies. And also, we see Amazon, Microsoft, and Apple all have $1 trillion valuations, which is enormous. That's more than the bottom 350 companies in the S&P 500 all together. It's bigger than the 100 largest stocks on the London exchange. It's bigger than 23 of the developing world stock markets put together. These are anomalies that happen at important turning points in markets. So what I'm saying is, if you've been running into Amazon or Microsoft thinking it's a safe hiding place, I don't think it is. I think we could easily see Amazon drop 15%. Easily. And that just gets us to one of the moving average lines. That doesn't even get us below the moving average. That just gets us to the top moving average line. So if you're hiding out in these stocks thinking that they're safe and somehow they're not going to go down if the market goes down, I don't think that is a realistic thought. I think when the market goes down, these companies are going to go down too, because some people buy on margin. And that means that when the market goes down and their margin calls are triggered, that means that they are automatically sold out of their positions. And good companies, bad companies, and every company gets sold when you have a margin call. So whatever's in your portfolio, that gets sold out, and you don't have a say about it unless you can provide capital from the outside to reinforce your equity in your trading account. The brokerage firm will sell your stocks to cover your debt in your margin account. So that's how even good companies can get triggered. And sometimes they can get triggered to sell more because more people who were buying on margin might have bought those companies. So therefore, more of them might have to be sold if the margin calls get triggered. So I want to encourage you to be very cautious if you're buying individual stocks. They are not going to be the safe haven that's going to keep you from losing money if the stock market goes down. Number 2, I want you to be very aware that if you're not a sophisticated investor, this is not the time to be experimenting with buying stocks. And the reason for that is that we have more murkiness, more unclarity, lack of clarity than we've seen in a long time. And that means we don't know what balance sheets are looking like. We don't know what income statements are looking like. We don't know what the numbers are for any of these companies. And basically, buying a stock without doing the research on whether they're going to be financially solvent, whether they have lines of credit and liquidity, whether they have enough cash to make it through this time, means that basically you're just gambling and not really able to do any research or know anything about the company that you're buying. So be very, very cautious right now. It's my opinion that the bottom is not yet in. And so I don't see that this is the all clear time to be buying stocks, especially if you've never bought them before. And what concerns me is I hear a lot of people who have never bought stocks before who suddenly think this is a great time to invest. Well, if we knew that the bottom was in, that might be true. However, the fact that people are asking me and are very bullish and they have no investment experience leads me to believe that we are going lower in this market. That's one sign that tells me we have not yet seen the bottom. If people are too bullish, we haven't seen the bottom yet. I'm also seeing weakness in commodities here. That means that we can see a sell-off in gold and silver. We can see other commodities prices go lower. That tells us that deflation is still the order of the day. We saw oil trade negative to the $47 of the current month contract. And while that has never happened before, it just shows you the dislocation in markets and the fact that there's so much oversupply of oil that you literally had to pay someone else to take it off your hands. And while we have 75 million barrels going into the Strategic Petroleum Reserve, that's still not enough to clear up all of the glut of oil that's out there. And it's going to take the economy reopening and airplanes flying again and cruise ships cruising again before we can see some of this glut being taken up. Just stopping production or turning off a pipeline isn't enough to solve the problem. And it's anybody's guess how long it would take to unwind all of the supply of oil without having much demand for oil at this time. So this is a time for caution. This is not a time to be aggressive. We are probably going to roll over and test the lows and see if those lows hold. But we also are in a time where the Federal Reserve has come in and provided liquidity and backstops, and those kinds of things can really wreak havoc with the fundamentals. So something can be failing miserably, and then all of a sudden, if the Federal Reserve or the Secretary of the Treasury comes in and makes some sort of a bailout deal, it could completely disrupt the market the other way and send an asset price skyrocketing that had currently been falling like a rock. So these are the kinds of dislocations, the kinds of volatility, the kinds of challenges that we see right now. So err on the side of caution. This is not the time to be getting aggressive. We do not have the all clear sign, and we're likely going lower. We're still in the chasm. We don't know a lot of things. We don't know how quickly people are going to get back to work. We don't know if we're going to have another round of illness. We don't know what businesses are going to go bankrupt. There's a lot of unknowns, and we're right in the worst of it right now. So what I want to encourage you to do is listen to my Mindset Minute podcast, which was the podcast before this one. If you haven't already listened to that, that will give you some encouragement to get through this difficult time. And as we are getting through this, things are going to get better. We are going to have an amazing stock market later this year, but we're just in this very difficult chasm of time where it's deep and dark and murky, and we don't have a lot of clarity. And therefore, we don't have reality with our numbers, and we don't have reality with where the stock market's real value should be. It's still very unclear, and that's why we're sort of floating right now. But as soon as real numbers are able to come out in terms of earnings and profits and projections forward get clearer, then we're going to be talking about pinning a specific number on the stock market, and people are going to feel confident about where the stock market's real value is trading. Right now, we're sort of floating in never, never land. But as we get clarity and as the economy opens up, we're going to have more clarity, and that may take us lower around the July-August timeframe. So we'll just have to see how it all plays out. But this is not the time to be getting aggressive. It's not the time to think that the FANGs are going to rescue you and that they're just going to continue to go up, because that is not going to happen. So be sure you're taking good care of yourself, and I hope that you're healthy and safe and hanging in there through all of this. We will get to the other side, and things will be so much better later in the year. But right now, we just need to get through this one step at a time. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.